Okay, so let's get started. We have two presenters today. I like to break things up. We're going to spend about 20 minutes with each of them. At the end, we will take questions. So halfway through, after Eric's presentation, we will take questions. And then after Joe's presentation, we'll again take questions. So I'm going to turn it over to Eric at this point in time, and he's going to pull the presentation up on his desktop. So it will look a little nicer than what I had before. So while he loads this, Eric, I'm going to let you start talking now. Would you give us a little background on yourself, and then we'll get into your presentation.
Absolutely. Thank you for the introduction, Tom. Good afternoon, everyone. My name's Eric Gall. I run the Southwest Florida office for Florida Business Exchange. We're the largest non-franchise business in the state of Florida. I've been engaged in business sales for about 16 years, about 5 years in Southwest Florida. Before that, I did a lot of M&A work for Ford Motor Company in Dearborn, Michigan. What I'm going to talk to you today about is really 15 criteria business buyers focus on when valuing a business. As much as business owners hate to admit it, all businesses will eventually transfer. No one's on this planet forever, so the sooner you start to plan that transition, the better off your pocketbook will be once your day to transfer the business comes. One of the most renowned authors on business exit strategy or business transfers is a gentleman by the name of John H. Brown. He's an attorney from Colorado. John has a saying that there may be 50 ways to leave your lover, but only 4 ways to leave your business. And those 4 ways are, first, you can give it to your kids. Second, you can sell it to a second party, such as employees or your family members. Third, you can sell it to a third party, or the fourth option is you can liquidate it or bankrupt it, which is probably the worst of the options. So my focus is really on the middle two, sales to employees, family members, and third party. And those 2 of the 4 transfer methods are usually cash sales or finance sales. So naturally, if you're going to involve yourself in a sale of your business at some point in time, you're going to want to maximize the value of your business, and thereby maximize the price that a buyer will be willing to pay. I have a lot of conversations with business sellers, and a lot of the business owners like to tell me how much their business is worth. What's evident in all those discussions is that there is an emotional attachment that a business owner has to their business. Well, the fact is that business buyers don't share that same emotional attachment. They take a much more pragmatic approach to valuing a business. In the end, it really doesn't matter what a business owner thinks their business is worth. It doesn't matter what their CPA thinks it's worth. It doesn't matter what their cousins, nephews, sisters, uncle, brother thinks it's worth. The only thing that really matters is what a buyer is willing to pay for your business. So I'm going to go through 15 things that I think business owners need to pay attention to in order to get the best price possible for their business. First and foremost, if you want to get the best price, it's important to have clean financial records or clean books. Buyers love clarity. So the first thing that I recommend is that you and your accountant, agree to use standard accounting practices. Another thing that a lot of buyers do or sellers do is they put personal expenses on the books. If you can avoid it, great. But if you do put a personal expenses on your books, just make sure they're well documented and backed up with receipts. And a third recommendation is if you have cash in the business, and a lot of business owners I run into do, they don't like to pay taxes to Uncle Sam if they can avoid them, you need to document them. Now, if that documentation is within the point of sale system, that's great. If not, I've recommended people either put the money into a separate bank account where they can record it, or find some other means, like a second set of books to keep, in order to prove that that cash came in. Because in the end of the day, undocumented cash has zero value to a buyer. Second, buyers love businesses that are growing. A business that's generating year-over-year increases in revenue, discretionary earnings back to the seller, or EBITDA, for your larger Wall Street type deals, all naturally excite a buyer. This doesn't mean that a business that has flat sales, flat earnings, can't be sold. It just means the buyer is willing to pay a lot more for one, that they can see is growing sales and profits. Third, buyers are always looking for the hot new business or industry. As an example, we were introduced a few years back here where I live to the weigh and pay yogurt industry. And that's an example of what I'd call a fresh new business model that exploded. I remember the first one showed up in my hometown about 3 years ago, and I would say within a year, 5 or 6 more popped up literally overnight within a 10-mile radius. So any business where the economy and the industry outlooks are positive naturally attract buyers. Fourth, buyers love fast receivable turnover. I once owned a trucking company, and we shipped artwork and expensive pieces coast to coast. And the thing we loved about this business is that the customers paid us up front before we picked up their art pieces. So we knew how much we could afford to spend to move that item from pickup to its destination, and we knew we never had to deal with non-payment or bad debt. That cash was in our pockets, before we performed the service. So buyers love businesses where they get all their cash or as much cash as possible, actually at time of sale or before. Fifth, buyers love to see business plans. Even though you're selling, a buyer will want to know you're still thinking about the future of the business. I always recommend that the plan not be long. I think a 2 to 3 page plan plus some financial projections is more than sufficient. One thing that I want to point out is, as an added benefit, if the buyer is going to require outside financing from a bank or an SBA loan to purchase a business, SBA requires a business plan. So if you have one in place, it saves the buyer from creating their own plan. And when they go to create that plan, generally they rely a lot on the seller's time and experience to help them write it. So if you have one in place, it certainly makes a finance sale much, much easier. Six, businesses with high customer diversity are worth more in the market. General rule of thumb is no single customer should account more than 15% of revenue.
Hey, excuse me a second, Eric.
Sure.
Hey, Eric, you there? I've got one comment. You're breaking up just a little bit, so let's talk a little bit louder. I think we'll be there.
Okay, thank you.
Frank, let me know if that's doing better.
All right, the sixth characteristic is businesses with high customer diversity are worth more than those with low customer diversity. The general rule of thumb is a single customer shouldn't account for more than 15% of revenue. Businesses that have low customer diversity are considered risky by buyers. The thought process here is that they'll ask themselves, what if that large buyer leaves? How is that going to impact revenues? How will that lost revenue impact the bottom line? Now, you may not have much control over customer diversity, but if your customer diversity is low, you have a buyer that's a large part of your revenue base, then the recommendation is to focus on adding new customers versus extracting more out of your existing customers. Seventh characteristic is low owner involvement. A business where the owner is the business and their transactions are highly personal, such as an accountant or an attorney, those businesses are also considered risky by a buyer. A buyer will wonder, well, what if the customers don't like me? Or what if the customers don't like my style? Will I be able to keep them? If I can't keep them, how much revenue will I lose? How much is that going to impact the bottom line? So businesses where you have a staff in place to handle customers and operations have much more value to a buyer than a business where the business relies on you, the seller, and then once they purchase it, it's transferred to them. It relies on them, the buyer. The eighth characteristic is buyers like businesses with high product diversity. Similar to customer diversity, the general rule of thumb is no single product should account for more than half of your sales. Businesses with low product diversity, again, are considered risky by buyers. For example, if new technology renders your primary product obsolete, they're going to wonder or worry about how it impacts revenues and how the lost revenue impacts the bottom line. If your product diversity is low, the recommendation here is to focus on adding new products versus growing the sales of your existing products. Ninth, buyers really like businesses that have fast transaction rates, and by transaction rates I mean repeat business. So in the photos here you see on the right businesses like grocery stores or pharmacies where you have customers that continually come back frequently and purchase from you. Those generally have greater value in buyers' eyes than a business that's a one-time deal, as on the left. Now, businesses with repeat business, generally are more predictable in revenue and therefore predictable in their bottom line. And marketing costs to acquire buyers is much less in a repeat business or a highly frequented business than a one-time deal. Tenth characteristic is the existence of a strong management team. Similar to low owner involvement, a situation where the owner is not running the day-to-day operations has great value to a buyer. I'm sure you've heard the phrases work on the business and not work in the business. Buyers want to work on the business. So a strong incentivized management team will allow them to do this. Now, of course, if you're a big part of the business, working out means to push some of your responsibilities onto your staff, is critical to increasing value of your business. 11th is low employee turnover. Low employee turnover really sends a strong signal to a buyer that the seller has a strong management team in place. Employees are adequately compensated and incentivized, and the business has minimal underlying business issues. So if you've kept your employees a long time and they haven't changed, that is really a good, strong signal to a buyer that you've got a good, solid business model. 12th consideration is active assets, and I'll give you a quick story here. I once had a plumber who I listed his business for sale. In the height of the construction boom, he had 20 men and 14 vans. Once the boom ended, he was down to 4 men and 14 vans. He wanted me to sell his business for the standard multiple of revenue and owner benefit, plus he wanted an extra $100,000 for those 10 idle vans. I recommended right away that he sell those 10 idle vans, and his response was, well, if things pick up, I don't need to go and buy more vans. And I told him if things pick up again and you can use all those vans, you're not going to want to sell. So he resisted me for about 12 months. The listing didn't get much interest from buyers, and when it did, the feedback was consistent, and that was straight from the buyers. If I buy this business, the first thing I need to do is divert my attention from learning the business to selling his excess vans. So in month 12, he was finally convinced, and he sold his vans, and I think it was about 2.5 months later we sold his business. The 13th value creator is accepting seller financing. There's many benefits to seller financing for a seller. Those include faster sale. You'll attract more buyers, that's for sure. Deferred payments to you for the business means deferred taxes. And finally, historically, finance sales generate about 16% more in price than a non-financed or cash sale. So on $1 million business sale, that's about $160,000 more into your pocket before taxes. The 14th consideration is proprietary technology. Now, this doesn't come up for me all that often. I have things like software companies for sale where they do protected technology. But when it does, any barrier to entry or any prevention to free competition has tremendous value to a buyer. So if you have patents and copyrights, those are perfect examples of barriers that a buyer will pay a premium for. And finally, the 15th consideration is documented processes and procedures. A business owner who's taken the time to document processes and procedures demonstrates to a buyer they know their business, and it's a good sign that their employees probably know the business pretty well as well. So it's a good control mechanism, provides a great baseline for the buyer for improvement. They can use those documents as that baseline. So these are the 15 criteria that business buyers focus on when valuing a business. Obviously, my interest is in helping you sell your business for the maximum price possible. And I'm assuming that your interest is or will eventually be the same as mine. I'm sure this is a bit overwhelming, all these things, in a single business, but understand this. I've yet to find a business owner with all these items in place. And there's no such thing as a perfect business. There is, however, people who can help you eliminate some of the defects in your business. We usually call them consultants or business coaches. I guess with that, I'll entertain any questions before turning it over to Joe.
So if you have any questions, if you would type them in the chats there. And if you think of something while Joe's presenting, then feel free to set in. And we'll summarize everything at the end. Thank you, Eric. I do know I've been working with Eric for a couple months now, and we turned over business to him that was struggling to sell, and he just got it's in due diligence now, so he's a man that does what he says he can do on that side of things. Very impressed with that. So at this point, we're going to turn it over to Joe and make him a presenter here. Joe, you out there?
Yeah, I'm ready for you.
Okay, Joe's our partner in the business consulting here at Omni, and we work with businesses every day. He's going to go through our side of what we see in a business and really what it takes to make a business ready to sell. And world-class businesses position themselves where they're always ready to sell. They may decide not to sell it, but it's always nice to know that it's out there and prepared that if a buyer comes along, you have that opportunity. So with that said, Joe is messing with Windows 8. Everybody knows that's a nice change in things.
Okay.
Now hit the
we're all
yellow
ready to
button
go.
on that one.
Okay, again, my name is Joe Pfeiffer, and I work
No.
with Omni. And
Joe, hold up a
Yeah.
second. I don't think it's up there. It's not showing up on my screen. You click the button, so click it again if you wouldn't mind.
Okay.
There we go. Here it comes.
Again.
This time
See it
when you
now?
minimize quick meeting, use the yellow button to minimize it. There you go. There we go. You're ready to go.
Rock and roll.
Rock and roll.
Okay. Again, my name is Joe Pfeiffer. I'm with Omni. I work with Omni to help businesses find solutions to their problems. And in this particular case, today we're going to be discussing how to get your business ready for sale. If you're like most business owners, you've taken a lot of your available capital and you've invested it in your business with hopes that at some point when you want to sell the business, you'll have that available capital back with interest. But unfortunately, lots of times business owners really don't fully understand how to effectively prepare their business for sale. Now, Eric just went over a lot of great ideas and points, and what we're going to try to do is drill down into some of those, give you some actual examples. First off, most business owners are typically juggling the responsibilities and day-to-day issues that come up with just trying to manage and run the business and don't have time to prepare the business for sale. So one of the first things a business owner is going to have to do is come up with a plan that they can assign and delegate responsibilities and assign dates so that they continue to run the business while at the same time can start to prepare the business for sale. There basically, as we talked about, two aspects that are really used in valuing the business: the financials and then all the various applications of the business that were discussed, particularly the documentation of business processes, these type of things. And so if you were trying to decide what type of business to invest in and you put yourself in the shoes of the buyer, you'd probably think pretty quickly if you came across a business that seemed to have idle employees or confused processes, this might be a questionable business, versus a business that almost seemed to run itself without the need of constant involvement from key employees. So what specifically would you look for in a business if you were going to go out and buy one? And obviously that's the question you need to ask first so that you can effectively identify what to do to prepare your business. Well, at Omni, we sit down with business owners and we go through this checklist or pyramid, as it were, to make sure that they've got a lot of these key building blocks in place. Obviously, the foundation is, as Eric mentioned, having the right leadership in place so that you know there's going to be the proper guidance, but not the dependency of either the owner or key employees once the business is sold. You want to make sure that you've got documented and defined roles and responsibilities, effective training programs, performance evaluations that are given quarterly to the employees, and bonus incentive programs to keep the employees motivated. Effective two-way communication so that the employees can constantly be heard and their ideas and perspective are represented in all the final decisions. You want to, of course, still have an accountability program that holds everybody responsible for all their defined responsibilities. And then you obviously want to have an organizational structure that is as flat as it can be so you don't have a lot of wasted people performing supervision or management tools that really aren't adding value to the company. That's where, as you better define roles and responsibilities, the employees can become more partners and don't require constant supervision, thereby allowing you to flatten out that organizational structure. Obviously, the business has to have clear goals moving forward, both short-term and long-term. There has to be effective planning. There has to be efficient processes and procedures in place. And then all the various attributes that describe characteristics of the employees and staff that really add value. But finally, and most important moving forward, is there has to be effective vision as to where the business is going. And as Eric mentioned, you want to be in a market that looks like it has some future opportunity. so that it's not going to be something that's going to die on the vine as soon as you take it over. On the outside of the pyramid, you can see the various attributes that result from having these building blocks in place. Increased productivity, reduced variable expenses and reduced fixed expenses, increased revenue and increased efficiencies. And on the other side, the adhesion or the mortar to the bricks, people working together as partners, having the right people in the right place, similar to Jim Collins' book back in the early 2000s, getting the right person in the right side of the bus. And then, of course, learning from mistakes and documenting the changes to the procedures or the job methods, or also putting those mistakes or unusual conditions in a contingency plan. And, of course, maximizing the potential of all the employees, making sure they're fully utilized and you got the employees well-trained doing the jobs they're best suited for, and then always working on employee morale so that everybody's participating at their best level. Three key components of any business, obviously, their operations, their marketing and sales, and their financial programs and tools. The effective operations of any business obviously require processes, procedures, systems, and controls, and we're going to drill down on those in a couple minutes and get to the specific tools needed to maximize effective processes, procedures, and have systems in place that aren't running the business but that help run the business. And then, of course, controls to mitigate the risk. Now, effective marketing and sales is probably one of the most elusive attributes of any business right now. And it makes it difficult, in many cases, for a small business owner to stay on top of things because they're working with a very limited budget, and everything they invest in their promotions or their marketing plans have to maximize the return of the dollars. But this also plays to changing technologies and cultural interfaces that now, of course, are relying much more on smartphones, website involvement with search engine optimization maximized, and a variety of services that are provided directly from the website. So this is an ongoing moving target and is always one of the greatest challenges for any business owner to make sure that when they're ready to sell the business, the thing you have to prove is that the programs you have in place now can generate sales necessary to grow or manage the profitabilities to effectively represent the business. Now, with the financial planning and performance reports, this is something that really hasn't changed over time. This is something that goes back to the basics. I think Eric was covering several of these things. You start off making sure that you've got the right chart of accounts to represent each cost and revenue center. Not too many, just like a recipe. You don't want to have too many ingredients. You just want to have the right ingredients to provide the flavor you're looking for. Of course, you have to have the routine reports, your balance and income statements on a monthly basis, but you want to make sure you've got a P&L report that has a variance component to it so that you can compare this year to last year or this month to last year, and you can track when key charts of accounts or key costs or revenue centers are changing, and you can drill down to find out why they're changing and try to get that corrected before the pattern continues. You also, of course, want to have annual budgets that have a variable component so they can be adjusted throughout the year. Cash flows are very important, particularly for peak periods, 9 to 12 months out, to make sure that you're going to have the available revenues in place. And of course, you want to make sure that you're doing the type of break-even analysis with analysis of your fixed and overhead and fully burdened labor so that you can then in turn develop effective pricing tools or bid sheets that truly represent both the fixed and variable costs of the business, and then allowing for whatever designated profit you're looking for. Again, these reports have to be easy and clear to read, and they are the dashboard of the business. They tell you when there's a warning light, when something needs to be fixed. The easier these are to read, the more marketable it's going to be to the buyer. Now, another big component, as Eric brought out, is that you are going to have to demonstrate how a new buyer is going to be able to replicate past successes. Are there going to be dependencies on key employees or the owner, or is this a package similar to a McDonald's franchise where I can just open this thing up and run it myself? we suggest there are two top secret weapons that really affect this opportunity, that give you the best opportunity to make this a smooth transition. The first is your operations manual. The operations manual is the user guide or the direction manual of how to run this business. If it's effectively laid out, it should have all detailed business process maps to show exactly how the business operates. It should have a table of contents that identifies each key component of the business and what tools, forms, reports, or processes represent those. And it, of course, should have a good functional org chart so that it can identify all the different resources and what those resources do. Now at Omni, we recommend that there are 4 component tools for each individual job position on that org chart. And this is key, and this really does help define the business. The first tool is a tool that identifies the specific responsibilities for that position and about how much time is spent on each responsibility. That does 2 things. That allows me to know exactly what that position does, and at the same time allows me to know how well that position is utilized, so that in the event that I'm sitting in a management meeting and I want to start delegating additional responsibility out, I know who has the greatest availability. The second key component is having job methods tied to each one of those responsibilities listed on that responsibility sheet. Those are a serialistic step-by-step set of tasks on how to perform that job or responsibility that was listed. And in many cases, when you have those well documented, over time, if the employee takes responsibility for those, as they accumulate additional job knowledge, which normally just sits in the heads of the employees, they can in turn document that into those job method lists, and they can increase the effectiveness by making those job method lists both continuous improvement and best practice. And that is a significant component to any business, particularly in the events of change that we see on a day-to-day basis. The third component is just having a job description or employee job contract that clearly defines exactly what are the key needs, attributes, characteristics of the position who's going to be, the person who's going to be most successful in that position. And obviously that's what you're going to be using whenever you're trying to go out and recruit for that position. And then finally, and maybe most important, is to have a highly objective evaluation form that you can review with the employee on a quarterly basis. Now, the reason you use the form quarterly is it's just like a teacher trying to prepare a student for a final exam. The more often you can correct an employee and put them on the right track, the greater the opportunity they're going to achieve success. And particularly, as most business owners do, they wait till the 4th evaluation at the end of the year to determine how that person is going to participate in their bonus incentive program. So that it not only builds morale by reinforcing the employee and teaching them constantly how to be better, at the same token, when they do get to the end, they have the best chance of maximizing their grade or their performance for that year. The second key component is obviously the people. The people that you select have to have the right characteristics and skills. You want these people motivated. You want these people to act more like partners than employees. And of course, you want to be able to retain these people, which is key in today's market. And obviously, a lot of businesses are challenged with that because there are so many opportunities for people to transition between jobs and careers, particularly with the technology available with all the different tools, LinkedIn and with Monster.com and Career Builder and all the different recruiting resources out there. You have to have the right tools in place to make sure that you're not going to have those key or top performing employees drawn away from you. We suggest there are 7 keys to retain employees. There are probably more than this, but these are the ones that seem to be most effective. First off, as I said earlier, having all the roles and responsibilities or duties documented. The employee clearly knows exactly what's expected of them. You want to constantly have an evolving set of goals so the employee is motivated to continue to improve and perform, and they can clearly see how their performance affects the overall value and performance of the business. That gives them a lot more reward incentive than just telling them, okay, you're doing a great job, go back to whatever you were doing. Obviously, the key performance indices are an important part to make sure that we clearly define when is that job producing effectively, when is it fully productive. And when the employee knows that, then if there's a problem and they fall below those indices, we help the employee identify what conditions be adjusted or what they can do to personally perform at all times using normal skills, normal efforts, under normal conditions with a well-defined operation. We talked about earlier the quarterly reviews and how important they are. And then setting up a bonus program that may be paid annually, and it usually has components, a cash component, and then as the next level indicates, a bonus that could be vested into a deferred income program so that it is an incentive for the employee to stay because they know they have to stay so many years before they're eligible to get back that part of the bonus. And that's particularly effective when there's just a slight variation improvement in salary or hourly rates a competitor is trying to use to draw that one of your key employees out of the business. Lots of times we use non-compete programs or contracts for employees that have particular skills or are exposed to unique or sensitive information. That way they won't at least take that information, be motivated to take that information onto a competitor. So these are the 7 keys to retain employees, and we hope that with some of the things we went through quickly today, it gives you a little more specific insight to the type of things you need to have in your business to achieve what Eric covered in his points, which are great reviews to identify how you can maximize both the marketability and value of the business. And I'll turn it back to you, Tom.
Okay, nice job, Joe. We've got a few slides I want to show at the very end here while we wrap things up. But if you have questions that pertains to what Joe spoke about, I had a couple of folks ask for a draft business plan that would prep them for what Eric looks for. Eric is out there. He posted his email address. He can send you a sample pro forma that you would need. Joe and I will send out the draft business plans. Something we work with customers on all the time. But basically, every company we go into, every business owner I meet, they're all at different points of the lifestyle. Every situation is unique. There are things that change ownership, whether it be that someone is getting older, they have health concerns, there are outside factors, there are competition, we have government regulations nowadays. Some people just get fed up messing with them. You could be at a new stage of life. We've had people come to us and say, look, I want to do more and volunteer more, and I have kids at different ages, what have you. We've had business owners that are at odds with each other. We've got one business owner we're working with down south that's one of them's older, one of them's younger, and they're at 2 different stages of their life. One wants to expand the business and one wants to just hold it safe. So maybe just curious, what's the business worth? And then there's the old burnout factor, this fact that I'm tired of putting up with it. I'd like to sell it out to someone else. The key is, an example I use is my wife and I have an old home, and it is a lot of upkeep. So we got fed up one day and we said, we're going to get it ready to sell. So for months we worked on it. We got everything right, low maintenance yard, everything like that. Sitting on the front porch, and we're like, wow, this place is pretty nice. So we decided not to sell it, but it's ready. When we're ready to pull that string, we're empty nesters now, it's there. So the succession plan, you don't want to wait until something happens, till there's an issue with your health, there's a family change. So what you need to do is always be thinking about it. Just another ball in the air that the business owner has to juggle. So what I encourage from this, if you take away one thing, is to engage the correct resource. Don't talk to your buddies on the golf course about it. I mean, you can, but what kind of advice you're going to get there? If you have a great relationship with your CPA, go to them and say, look, this is what I'm thinking about. Engage someone who has really a third-party relationship with you so that they don't have a vested interest, you know, not at Thanksgiving, not over the family dinner table or what have you. I always encourage that the spouse is involved if they are active in the business. But every business, and Eric said this, must transition at one point in time. So you've got to know, what do I need to exit? You know, what is my financial position? How much is my business worth, and is there a difference? One of the best parts of my job is that we offer free consultation. 1, 2 hours, whatever it be, is that we sit down with business owners and really cover, it's for them. It's a roll up sleeves working session, and we go through confidentially, you know, how's the business going, where we're at. I encourage that spouses are involved with it, because in a family-owned or one business owner, it is not self-contained. It affects their whole life. And we really enjoy helping customers do that. Again, let's see. Eric says it's never too late to plan your exit, but it can be too late. It can be too late. That's good. So if anyone has any questions, type them in the chat. I'll remain on here just a little bit longer. This is being taped and recorded again. That's why we behaved ourselves. And so the email's on there. My email you should have received when you received the invitation. Phone number's there to reach out for us. You can jump on our website, and we can direct you to Eric. So I want to thank you for your participation. Next month is going to be about search engine optimization and how not to get ripped off for it. And I'm really excited about that one. So to share that information with folks. So thank you for your participation, and we'll wrap up at this time.